Welcome back. Well, the markets are holding in the green, and the key mark that you're looking forward to on the upside is 17,700. This market has just positioned itself in such a way that today being expiry, we don't get past that 17,700 odd mark. If by chance the bulls can get above that level and hold above that level, then we are bracing for a big short covering bounce actually to play out. So let's see whether or not that happens. But for the time being, 40-50 points is what we're holding at. Let's focus on a stock that's been literally buzzing around. Som Distilleries, the stock is on our radar. Remember, it's been buzzing in trade. It's up close to around 27% in a month. Even this morning, it's higher in trade. One of their wholly owned subsidiaries, well, they've started commercial production of beer. Mr. J.K. Arora, Chairman at Som Distilleries, joins us on the show. Hi, Mr. Arora. Good morning, and thanks so much for joining in. Well, we spoke to you, I think, a couple of months or so ago, and you were sounding extremely optimistic. So, since you're in silent period, we don't know anything about FY23. But with regard to FY24, you had put out some numbers that you'll do close to around 1,000 crores of revenues, margins in that vicinity of around 13 to around 14%, and your market share as well will go towards around 15%. Do you hold on to all those three, revenue, margins, and market share?
I believe the figures are going to be a little better than this. It's not going to be anything lesser than that, because the capacity expansion achievement has been done on time just before the season. So we hope to achieve all that numbers, and more than 1,000 crore revenue is for sure.
But how much more than 1,000 crores can you do since your expansions have come on stream? Do you want to revise that number upwards to say 1,100, 1,050, or for the time being, do you want to keep it at just 1,000 crores plus?
Yeah. I think because of the cooling period, I think let's not talk on the numbers, because we have the result due on 26th April. But as I said, since the earlier in Madhya Pradesh and our Bhopal unit used to have 30% bottles and 30% can and 70% bottle sale. And now, after this our expansion, which has been just came on time, the ratio has just reversed. 60% can is being sold now, and 40% is the bottle. So, which is a very big boost to us, because we have put up with a capacity 3 times of our capacity of the canning. And this same time, this boom has come. So, we are going to be really benefited from this. And same time, our Karnataka unit has also gone from 45 lakh cases to 90 lakh cases, double the capacity. So that is also has come on time. So even after doing this double the capacity in Karnataka, we are still short of capacity. So we are fully utilized. So let's keep fingers crossed. We hope something better is going to happen in the coming financial year.
Good times are flowing, huh?
Yeah.
I was just thinking, it's such a great business to be in, right? I mean, temperatures are soaring, and the only way you can beat that is by opening a cold one.
You can have
chilled one.
You can have Ruabs, Sonia.
Teetotaler. Teetotaler stocking it there.
Anyway.
By the way, I am also teetotaler.
Oh, wow.
Wonderful, sir.
I don't know how you managed to do that, though, being in this business.
Mr. Arora, but we don't really do research with regard to the annual reports and the financials. I called up the local vendor down the road and I've asked them a few times. They said that they don't have all the brands that you sell, Hunter, Blackford, as well as Powercool. For the time being, I think you're focusing on Madhya Pradesh, Karnataka. Any plans on getting into the Maharashtra market?
Yeah, I should tell you what exactly you should, since you are into a business of knowing the companies. I will tell you in just 2 lines. You see, it is in Constitution, the liquor business is delegated to state governments. So when we do the business, when we do the business in 26 states, we are doing the business in 26 countries, because every state has got its own sets of law, own sets of rules and permissions. And from one state to another state, when we transfer the stocks, it is a export tax and import tax. The state you are producing, they put the export tax, and the state which is you are bringing in, they put in the import tax. So it is this thing. So you need to have either a neutral territory like Delhi, Delhi does not have any manufacturing unit of any kind of liquor. So you have a equal level of field for everyone. So there is no issues of the import tax or export tax. But like Maharashtra is almost having the import tax of the, say, 40% of the cost. This thing. So if you have a margins of, say, 15%, 20% or 14%, 13%, how can you pay the 40% of the import tax? So this is the issue actually. But wherever we are present, we are in a excellent, like in Madhya Pradesh, we are number 1. Karnataka, we are there, we are number 2. Odisha, we are number 2. Against the United Breweries, which has been a very, very established and enjoying the 50% market share in the country. We are into number 2 position. Delhi, we are number 2. So this is as far as Maharashtra is concerned, we are there, but we are not there in a substantial way. So unless we have our manufacturing setup there, either by way of tying up with someone or maybe our own manufacturing unit, you cannot be grow in a bigger way. That is the
Got it. Mr. Arora, would you is that under consideration to set up?
Yes, very much. We are the states on our radar is Maharashtra, Telangana, Tamil Nadu, and UP. These 4 states are in next 2 years we are targeting for to have our production arrangement there in all these 4 states.
And these will be, and you will set up your own units, greenfield, or you will tie up with somebody in these states?
It depends on opportunity. Like in Maharashtra, we have talking with some takeover. If that gets through, fine. Otherwise, option of putting a greenfield is always there.
Okay.
And how much do you plan to, I mean, if you were these conversations that you're having in for these, I mean, how much would you have to pay to acquire these?
300 crores approximate. It means
300 crores.
Two thing is for the unit and then another 100 crore for the working capital.
Okay, and we will we could hear something soon, sir?
Yeah, as I said, we are working on these 4 states to and whichever comes first is most welcome, because all these 4 states are almost equal and almost potential and most suiting to our portfolio of our brands.
Okay, I'm sure there's a lot of excitement here in the studio to know that you're coming to Maharashtra in a big way very soon. The excitement is palpable here. But tell me a little bit about overall market share. 15% is the market share that you were guiding for by the end of FY24. How do you plan to get to that? And over the next couple of years, what would your internal target be?
You see, the things are quite bright. I would say everywhere, wherever we are, it's doing pretty well. And fortunately, this business is also a game of scale and the capacities. So we are at the most advantageous position in comparison to all the players in the country. You see, we are the one who can take quick decisions and can grab the opportunity. So we say like this addition of capacity. Last year, we were hardly utilizing the capacities of Karnataka and Madhya Pradesh. But we could see the potential and we took the decision very fast to add on the capacity, and we did it and we got the advantage. No company, especially multinationals, can take such fast decisions and get this thing. So business is one thing that if opportunity knocks you, you should grab it. So we are that advantageous position on that, and we are on our way, and I am quite sure that things are going to be quite better in the coming years.
Mr. Arora, just one question. You said with this Bhopal unit, canning unit, 60% is cans now. This is 60% overall sales? Or this is out of
Yes.
60% overall beer sales are canned?
Yes. If the 100 bottles are sold, 60 bottles are in the can, and which is actually beaten all our estimates also.
Right. Aren't bottles cheaper? Is it? I mean, what's the trade-off? Why would you? I mean, I'm assuming cans are more premium in that sense.
You mean draft beer, is it?
No, I'm saying the
beer
difference. Why would you go for cans instead of bottles?
No, it's not what we go for. It is all the consumer what they want. It is
Okay.
you see, suddenly the choice of the consumer has gone for this thing everywhere. The can is improving, and another reason is, let me be honest to you, is shortage of glass bottles, because 70% of the country's production is being done by the one single unit, Hindustan National Glass HNG, which has gone for the NCLT last year, which has created a lot of difficulties for all the pharma and beer and liquor manufacturers. So the need.
You're saying it's a combination. It's a combination of shortage of bottles, but also consumer preference towards cans.
Correct. And pricing has also been set by the manufacturers in such a way that can is being promoted more.
All right. Thank you very much, Mr. Arora. Good luck. Thank you very much for being with us here on CNBC TV18. And we'll speak with you soon again once we hear on those acquisition attempts in Maharashtra and, of course, the other 3 states as well. Stocks doing very well. Well, our special segment, Quarter Se Quarter Tak, Nigel has walked across to the big wall. He's going to take us through expectations from the cement sector. Nigel, over to you.
Well, strong cement demand was witnessed in January as well as February, though there was some slowdown in demand in parts of March 2023. Now, pre-election spending continues to boost infra segment demand in multiple states. That's what's driving the overall cement demand growth. Mid-team volume growth is expected for the bigger names, Ultratech Cement, Dalmia, Shree Cement, as well as JK Cement. They should report mid-teens, maybe 13 to around 16% volume growth. While Ramco Cement, well, that's expected to grow by close to around 20%. Now, the large will dominate and outgrow the smaller cement players. That's what the street expects. Companies with capacity additions in the past 1 year and with Southeast regional presence, well, they could marginally outperform the industry growth. Now, the volume growth for FY23, while if you're looking at Adani Cement Twins, that's ACC, as well as Ambuja Cements, they will be negatively impacted owing to the Himachal Pradesh plant closure for parts of the past quarter. Now, costs are likely to have started a downward spiral and will soften further in Q4 FY23. That's because of low energy cost, better operating leverage since volumes will be higher, and reduced maintenance expenses due to peak season. That's Q4. Now, this benefit of cost decline is likely to extend for a couple of more quarters based on the current prices of raw material and also at current energy costs. The problem is the volume push strategy seems to have impacted the pricing, and that's why prices were pretty much depressed in Q4 FY23. Some channel checks indicate that the cement prices at an all-India level have slipped and are likely to be flat to marginally negative sequentially. Producers in the northern region, they are likely to report some growth in terms of pricing on a sequential basis. And they are better placed in comparison to the southern states, where out there you've seen a sequential decline. Jefferies, they see that the energy cost decline and operating leverage will drive up the EBITDA per ton by an average of around 135 rupees per ton on a sequential basis. That's for their coverage universe. Adding that from their coverage EBITDA is likely to be largely stable for FY23, that's for the Q4, after declining by around 3 to around 44% for the past 6 quarters. There'll also be a good improvement for most companies on a sequential basis, and particularly for Birla Corp on a low base, while Dalmia Bharat, well, they'll see a bit of a decline on a high base. Well, a quick run through on the expectations of select companies is below. While Ultratech is expected to post a solid set, while Ramco's top line growth is expected driven by higher volumes. Finally, as we wind down, we leave you with a snapshot on the valuation front. So that's all the stocks up for you on the screen. Well, let's take this discussion forward. We have Mangesh Badang, the Senior Vice President Research at Centrum, who joins us on the show. Hi, Mangesh. Thanks so much for joining in. Well, what's your estimate? First, if you could tell us what kind of an EBITDA per ton improvement are you factoring in for Q4? And also on the cost side, what is the softening you're looking at for Q4 as well as for Q1?
Yeah, good morning. Good morning, Nigel. Nice to be back after some time. So for this quarter, we are looking at 170 to 180 rupees improvement in EBITDA per ton. And that would largely be driven by the reduction in cost. So for the pricing front, as you mentioned, North was better as well as South was weak. So it gets averaged out a bit, and pricing is more or less flattish for our coverage universe. But the cost reduction is there, 170 to 180 rupees because of lower coal, and that's what is going to factor in this time around. Additionally, Q4 generally has relatively lower per ton cost because the volumes being higher, the other expenses as well as employee costs are on the lower side. For first quarter, again, given the fact that the coal prices have actually gone down further, now up to below $140 per ton, we are expecting that the cost should go down further by 150 to 200 rupees per ton. So this is the expectation for the first quarter. So that would actually be entirely be driven by the reduction.
Oops. Okay. All right. So 160, 170 rupees of cost decline. Mangesh, the problem for me is on pricing. You know, quarter 4, in a seasonally strong quarter, you don't see prices moving up. That's a bit of a worry. So my question to you is that what kind of price increases are you building into your estimates for FY24? Because prices, even in the initial part of April, some price increases were not totally absorbed. You know, I've checked with industry sources as well. So are you factoring in prices to improve, or is the earnings going to meet estimates because cost will be lower?
Right, Nigel, in the last 3 months, there have been 3 attempts to increase the prices and none of them have actually been delivered. So they have not been absorbed in the market. Barring, say, 10 to 15 rupees price hike in the non-trade segment in North, I don't think any of the region has seen the kind of increase that we were expecting. But on the other hand, you would have seen that the volume growth was very good. I think industry should report a double-digit volume growth in fourth quarter. And we believe the tendency of the companies is that whenever there is a volume growth, they would actually go for more market share gains rather than pricing growth. So we are expecting that the pricing should remain stable. We don't see any upside from here on. In fact, if it remains lower or if it remains stable at these levels, probably the EBITDA per ton expansion should be driven by the lower cost. So they don't need to increase the prices substantially from here on. I would be happy if the pricing remains stable at this level. And we are not building in any price hikes for FY24 coverage.
Oh. Okay, so that's good news then. If prices don't go up, then it's pretty much par for the course from you. But Mangesh, you know, as speaking to various industry sources, some bankers as well, it seems that inorganic activity could still pick up in FY24. Maybe from not the names that we heard in the past, maybe some of them will not participate, but some smaller assets, 8 to around 10 million ton assets could be on the block. Have you picked up something like that? And do you think that there could be some consolidations in some parts of India? Will it be in the west? Will it be in the south?
Yeah, so Nigel, if you look at the balance sheets of the large companies, the kind of balance sheets they have, it is actually very easy for them to go for acquisition. But as you know, it is very difficult to point out which are the assets which would actually go for sale. So if you look at most of the companies, the key factor which has actually in the past has worked for the acquisition or sale of the asset has been higher debt. So if you look at those assets, it could either be higher debt or probably because the promoter is not from the country or probably they want to do something else and that's why they would sell the cement business in the country. So those are the things that we have seen in the past. And there are definitely buyers in the market and the question mark is whether there are any willing sellers. However, we do believe that there would be a couple of deals that should happen in this year, but very difficult to name them at the moment.
All right. Final question then, Mangesh, before we let you go. What's your preference from, from the cement pack? Will you go with the big boy Ultratech Cement? Everyone was doubting there's going to be a new player in there, grab market share. But in fact, all that pressure out there, the stock has got bought into. And now they're expanding. Volumes are looking good as well. So you stick to the large cap name or would you go for some value buys from the broader markets?
So I generally we bifurcate our top picks based on the market cap. So for the large cap, we like Ultratech and Ambuja. And for the mid cap segment, we like Birla Corp and Nivoco, which are more of the value buys wherein we expect that there's going to be some growth as well.
Okay, thanks a lot for your thoughts and what to expect from the sector. By the way, the market has cooled off quite a bit actually. It's lost all of its early morning gains. And what's really dragging the market this morning is a lot of the pharma names. So there's some profit taking there. Divi's Labs, Apollo Hospitals, all under pressure right now. And even, some of these names like HCL Tech ahead of their numbers not looking that great. That stock is down 0.3%. In fact, we'll pose these questions to Mitesh Thakkar on the other side of the break. Some technical trades coming up as well. Do stay tuned in.
Well, the market's come off the highs. We just got, 10 points on the index. 17,630 is where we are at. Initial dip was bought, high was made, and there is a bit of a sell-off which has emerged as well. But, enough and more stocks which are, making waves. Soam Distilleries is just one name. We just spoke with the management. Mastec is another one. There's, of course, reacting to results. And Indigo Paints is another large one, which is up about 9% or so. It started strong. And it is going strong as well so far today. So those are a few names. By the way, Lux Industries is another one which should come up on your screen. Volumes have jumped massively, 12-13% on Lux Industries. That's the innerwear maker. And there is Sula as well. Sula when it's more alcohol after Soam Distilleries. But Sula is up about 6% for 407 on Sula, on large volumes, mind you. And ICICI Pru is another one which is up about 3%. Actually, it's not, I mentioned the Lux Industries stock, which is the innerwear company, but it's not just that. Look at Rupa and Company. Rupa and Company is up 10%. So there are at least two of these names which are jumping up, and they usually do move together. So that's something to keep an eye out on. Mitesh is with us.
Why would Sula and Rupa move together?
Yeah, even I'm wondering.
I don't get the correlation.
Blame the summer.
A heat wave effect. Lavabil, Rupa, all of them running out.
Soam and Sula, I can, but yeah, even that is a bit of a stretch, right? Anyway, Mitesh is with us. Mitesh, tell us, what do you do? The markets come off the highs. Do you think, the impulse will be to try and buy the dip?
Right, Prashant. I think you will see this kind of choppy moves given the fact that we are still in a range, we are still in consolidation. And the idea is that as long as 17,550 doesn't break, the bias will still be on the positive side. So try to buy closer to about 17,600, 17,585 kind of a zone with a stop below 17,540. Having said that, on the stock side also, we have been trading with fairly long bias. L&T is something which has come on the radar today morning. That's a buy with a stop just below levels of 22.25. And a target of 22.80, 22.85 is what I'm looking at on the upside. And the other one is PI Industries. After a breakout day before yesterday, yesterday was the day of consolidation. Today is showing continuation. So that's a buy with a stop just below today's low of 31.40. And a target of 32.40 is what I'm looking for.
All right, thanks for that, Mitesh. Well, let's shift focus now to the commodity markets. Manisha Gupta is joining in. Manisha, what's the one commodity that you're looking at today?
Sonia, I'm looking at the silver prices because we are trading very close to those one-year highs. The one-year high has been at around 25.8. So even with that 0.5% of a correction, we're not too far away from those kind of levels. The support comes in on the fact that you are looking at strong demand going forward. But the prices first, and we have seen 2.5% of decline on a week-on-week basis, and that shows on the prices. But on a month-on-month basis, we still are 13% on the higher side here. There is a World Silver Survey that got released yesterday from the International Silver Institute, and that says that the demand in the previous year was 18% higher at a record 1.24 billion ounces. They also go on to say that the demand has been strong across sectors. So whether it has been about jewelry, industry, physical coins and bar buying, all of that saw a double-digit growth on a year-on-year basis in the markets there. This is the third straight year that we are looking at a global deficit as well, and that data should tell you that. So when you look at the last couple of years, we've seen supply at just about 1,005 million ounces, while the demand has been much higher in both consecutive years. This year as well, even as we are looking at supply going on the higher side, the demand also is on the higher side, and that is going to keep the prices in support. So it's not just about artifacts and jewelry that is on strong demand, but the industrial demand from the solar industries and automotive also has been increasing there. So this is the next picture should show you the global deficit that we are working with now. So 2021 was 51 million ounces of a deficit. Last year was a huge 237 million ounces of a deficit. And this year we are working with 142 million ounces of a deficit yet again. So when you look at the fundamentals, they are very supportive for silver prices from here on. In the Indian markets as well, we're trading at around 75,000 rupees per kg with expectation that you could be looking at higher prices. So these are the average prices that we've seen in the last couple of years, with the expectation that the average price this year could be at around 21.3. We already are trading at around 25.5 right now, with an expectation that if 26 breaches, then you're looking at 28, even $30 per ounce on the higher side for the silver prices. So bullish going for this one.
Okay, thanks a lot, Manisha, for that. Well, let's get back to talking about individual stocks now. Mastek is in focus. The numbers are looking pretty good. The stock is up and about. Rima's here to give us the latest on that. Rima, over to you.
Thanks so much for that. Well, it's a solid set of numbers from Mastek, both on revenue.
Oops, there's some issue with your audio, Rima, so we'll just come back to you in a bit. Anything else that you've spotted this morning?
Yeah, I mean, Prashant is doing quite a bit of the spotting today, so I'm just wondering. But yeah, I mean, plenty of action actually in the broader markets, though the headline index is more or less flattish. You have IDFC now that's moved to the high point of the day. Just pull up the intraday chart out there. The stock had started more or less quiet, but now it's moving higher and moving higher on solid volumes, and BEL and BHEL as well. Both those two names doing pretty well. But Rima is back with us to tell us about Mastek's numbers, which looked very, very good. Rima?
Very good. And, you know, after the disappointing numbers from Infi as well as TCS, Mastek numbers have come in as a big positive surprise, right? Everyone is expecting weak set of earnings. So when you come out with a strong set of earnings, it really blows the lights out in terms of a stock price performance. Constant currency revenue growth of 5.3% quarter-on-quarter. Year-on-year revenue growth is almost inching towards a 20% jump. And remember, this is all organic growth, largely. So the organic revenue growth is more than 5%, and that is very commendable. And just to give you a reference, share count was anticipating a 1.8% growth. In contrast, the company has delivered a 5.3% growth. EBITDA margins too have expanded, as you can see on your screen, by close to about 50 basis points. Other internal metrics as well. Now remember, Mastek gets about 60% of its revenues from UK as well as Europe, and that is still holding up. Fairly resilient. The company has been diversifying the kind of work that it gets from Europe and UK, and that's a work geography which has seen a growth of more than 10%. The order book is strong, 5.2% on a quarter-on-quarter basis. The cash on the books is still very healthy despite the acquisitions that they did last year to the tune of about 270 crores. So looking good, and valuations too for Mastek are currently at about 12 to 15 times, which is much cheaper than the valuations of other mid-cap companies as well. So that on the sidelines adds to the support. Back to you.
Okay.
By the way, Sonia, Shopper's Stop is another one which is not there earlier. It's there in the mix now. About 6% gains. So there is a lot of stuff, individual mid-cap movers, which are sort of making large moves at this point in time. So that's the market for you. The Nifty has come off the highs, as we've been saying. 20 points or so is what we have. We'll take a quick break here. Excerpts from our exclusive discussion with Sanjeev Kumar Bijli, Executive Director at PVR Inox, on their business outlook going forward. Stay tuned. The conversation comes up.
Welcome back to Bazaar Morning Call. Let's now focus on the media and entertainment industry. The merged entity PVR Inox has introduced screening of movie trailers for 30 minutes at the cost of just ₹1 in a bid to shore up footfalls. This comes at a time when multiplexes are grappling with poor occupancies. Shilpa Ranipeta caught up with Sanjeev Kumar Bijli, the Executive Director PVR Inox, on the sidelines of PVR Pictures releasing a new anime movie, Suzumi, in India. Shilpa began by asking about these anime films, the business, and their outlook going forward. Listen in.
Released about over maybe 6-7 films. There seems to be an anime film that gets released after every, say, 2 months.
Okay.
And some of them, as I said, have done extremely well, $500,000 or $600,000 in gross box office. Some of them have not done that well. But overall, we're very happy with the response.
To talk about PVR Inox Pictures, I wanted to understand how big is this a business for PVR Inox overall at this point, and how does this also contribute towards the growth of the overall group?
Well, it's always been a very important subsidiary. I think PVR Inox Pictures as a distribution company has been a very important subsidiary because it's, first of all, it's a sizable business in terms of 200 crores and growing. And this, and in a good year, we can even do a revenue of 300 crores, because you have to understand the revenue is a function of the overall box office in the country. So since 22, 23 has been a lower number of box office, that not that many movies have done well, that's why it's a probably slightly depressed number. But if this year, with the kind of pipeline and the kind of movies that we're doing, that number could go up to 300 crores. So from a revenue point of view, it's very essential. And from a strategic point of view also, I think it adds a lot of value, because we are able to bring diversified content to our cinemas.
And you just said, right, that 2022-23 has been sort of a slow year for movies. We just saw one or two very big hits that have come in. Going forward also, what's it looking like? Do you think this lull period is going to go on for a while? Do you think, when do you think we'll be able to really get to pre-COVID levels of footfalls, of occupancy rates?
Again, this is an exciting year, exciting pipeline of films again. And I'm always going to be optimistic and sanguine about the fact that we're going to bounce back to the pre-pandemic levels soon.
Okay.
So I wouldn't say Q1, Q2, maybe Q2, Q3 of this year.
Okay.
We should be looking at good solid numbers and people coming back to the cinemas. I feel last year could be a combination of content that did not connect. And also perhaps that people had only content to watch during the lockdown, you know, and they wanted to do different things.
Right.
I think last year was a year of freedom. Let's travel, let's meet relatives and friends and, do other things that we weren't doing, going out, eating, drinking, traveling and all that. But I think that also has to plateau.
Okay.
How much of that can you also do? You know, that's something which also will find its level. And then the whole cycle of consumption of various entertainment activities will come back to normal.
Right.
Which I believe will happen this year.
I wanted to talk about the F&B bit. Now, before the merger of PVR and Inox also, for both individually, F&B was a very large segment.
Yeah.
And that is a revenue driver as well, even from a margin standpoint. So I wanted to understand now that we're looking at a merged entity, how does the F&B play out? Because again, both had different types or different sort of cultures of F&B also. Inox was always vegetarian, whereas PVR had non-veg. So how are you looking at the combined F&B play for PVR Inox, and the amount of contribution that it does to the business? Do you see that changing in any way?
No, absolutely. I think we've given guidelines on revenue, synergy revenues, on F&B to the markets and our investors, and we're very confident that we'll be able to enhance that F&B number by, 8 to 10% roughly. And a lot of that comes from adopting best practices. There's a lot of stuff that Inox was doing which was brilliant. There's a lot of stuff that we were doing which was different, which actually gave us a higher spend per head.
This 30-minute trailer show, right? I just wanted to get one comment from you, was that while you did see great response, I think 36,000 people in 4 days, but when we spoke to a few analysts, etc., the sort of the tone that came off was it looked like a desperate attempt to bring back footfalls because that's not happening. I just wanted to get your view on that.
I don't know what to say to the analysts. If we don't do anything, then we're not doing anything. When we're not doing enough to get people back, and if we do something, then it's desperate. I mean, I don't think that's a fair statement by the analysts, because companies have to try, innovate, do different things all the time. Our role is to actually go ahead and do experiments and see what works and what doesn't work.
That's interesting. Go to the theatre and watch a 30-minute trailer. I've never done that, but I would love to try. And you pay just ₹1 for it. Of course, you have to spend those 30 minutes doing something, so perhaps consume some F&B as well. That may be the strategy there. But that's PVR for you, talking about the business and the way forward. Well, for the market, we're just winding down by telling you that nothing much has happened in the first 2 hours of trade. Absolutely flat for the headline index. If anything, it started off well and lost some of its gains. So in that context, it's not been such a great morning. The Nifty has now moved into the red, but there are plenty of buzzing stocks, so don't go anywhere. On the other side of the break, we'll be back with chart busters to take all the action ahead. Thanks for watching Bazaar.